Welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence based, holistic insights to help you master the game of building wealth. My name's Campbell Wallace. I'll be filling in for Stuart today. And I'm going to be jumping into some listener questions today, and I'm determined to get through more than I usually do because there's some great questions in here and we have a lot of them. So let's jump into it. The first one comes from Fred. He'd like to be referred to as Fred. Fred says, many thanks for the excellent podcast, blog and YouTube channel. It's refreshing to have no BS, no ads and no marketing spin, just a good source of practical, interesting information. Thanks, Fred. Good on you. So Fred outlines his situation here. So he's 59, recently retired. And might I say, Fred, well done. You're in a great position here. So I'll go through explaining it. So Fred has 2.3 mil in super in a industry fund in balanced, which he, notes is more really classified as growth given that it's 70-30. I agree with that. His partner is a few years younger, still working on about 600 grand per year. Pretty good income there. The partner has 2.2 mil in super with a larger industry fund, also balanced, and the partner will probably retire in a year or two. They also then have a family trust with 3.4 mil, which Fred manages, and he's deploying into a similar style growth balanced asset allocation. It's currently got some cash in it, so it's probably, he says, more about 60-40 in terms of growth to defensive asset split, so kind of a balanced portfolio there. He's also got 450,000 in a high interest saving account in personal name. They own their home in Sydney, which is worth 3.5 mil, no debt. And really what Fred's asking here is he just wants a bit of a sanity check. He's outlined his plans here, which I'll explain, but really just wants to get our opinion and a bit of a sanity check on his plans and any suggestions of improvements and things that might be considered. So Fred's targeting a retirement income, an initial retirement income of 225,000 per year in spending, probably when he hits 60. And he mentions it's pretty much what they currently spend each year, have over the past handful of years. And then he says to help mitigate sequence of return and longevity, we're factoring in a 40 to 45 year retirement. He mentions, it's unlikely in the event that one of us lives to 105. Yep. I was thinking that some of the following. So spend conservatively. So he mentions a spending rate, of about 3.25%. So that's the percentage based off the asset pool. Cash bucket buffer assets with about 2 years worth of expenses. Yep. I like that. And having some flexibility around that. He also has plans to assist family members. So he's got a sibling that he plans to buy a unit in Sydney with them, questioning the ownership structure there. So maybe joint tenancy. So his portion, what he'd put towards it would be about 300,000 to 400,000. They'll initially rent it out, but in a few years, the sibling will move into it potentially for the rest of their life. And the other thing Fred's considering is each of our 3 children who are in their mid-20s wanting to gift, loan, or joint tenancy, something, giving money to them in some sort of way when they want to buy a house or start a business. And he's thinking about 500,000 each for these kids. So as I said, firstly, Fred, well done. You're in a great position here. Look, if you add up your super funds and the family trust, it's 7.9 mil in investment assets, liquid investment assets across the 2 super funds and the family trust. That's a pretty strong position to be in. So, if I'm looking at a really simple calculation that we do is just, as you've done as well, is just looking at if you want 225,000 to spend per year, well, you need to get a 3% earn. So even 3% income or 3% performance, doesn't really matter if it's capital growth or income really, because it's liquid assets. So, 3% of 7.9 is 237,000. So that's, your benchmark really of achieving 3% per annum is going to easily cover your living expenses indefinitely. And you're going to have a perpetual portfolio because there's going to be growth on top of that, surely. So that's pretty easily done. So, a 3% benchmark is going to get you easily your 225,000. And so then look, factoring in also, what if you put some money into this property with your sibling and you gift money to the kids? Well, my simple thinking is if you give 500,000 to each of the kids, and let's just assume you did this day one, so it's even based off your current financial position. So that'd be 1.5 mil going to the kids, and then let's round up and just say 500,000 goes into this property with the siblings. So then that's 2 mil. So if we shave 2 mil off 7.9, then you're at 5.9 mil, and then all you need is a 4% return on investment in order to achieve 236,000 of annual income or annual, retirement expenses. So again, it's a pretty low benchmark, a low watermark, really. Without these other sort of contributions or things that you want to do to assist family members, you pretty much need, on basic numbers, a 3% return in order to retain all capital, and it'll continue to grow. Or if you gifted all of it, all of these giftings happened within the first year, you'd need about a 4% return. So pretty easily done. So you can see what I mean. You're in a great financial position there. So well done. So look, the sanity check from my perspective is, it ticks off. I'm sure you're going to be fine. It's looking pretty strong. And look, I'm sure, you've factored in, a lot of people factor in, which I think is the right thing to do, the retirement income based off what they currently spend before retirement as of the last few years, I think that's a great way to do it. But, in reality, are you going to be spending what you do today and in the next 5 years when you're 90 years old? Definitely not, So, I mean, that's just the reality of it. But, I mean, I think we like doing this in plans as well. We work off, well, what do you currently spend? Well, that's going to be your retirement income. And then let's try and continue that all the way through for your entire life as a very conservative sort of base scenario. So, yeah, it's certainly going to work. I think the sanity check is absolutely there, Fred. Now, in terms of this unit with your sibling, you're considering, whether to do it joint tenancy tenants in common or joint ownership. I guess that really depends on whether you think or whether you're happy to eventually gift that portion of the property to your sibling. I think if you're kind of considering it as an assistance for family members, as you word it, and it's going to eventually be gifted to them. So, in the event that you were to pass away, what would you want to happen with that portion, your portion of that property? If you'd be happy just to give it to your sibling, then I think the easiest way is to do joint ownership on it. However, if you kind of wanted to retain that as really that portion of the property is your asset, then you would go down the joint tenancy route. I guess the only complication with this is, in the event of your death, the person, your sibling, would need to buy out. That's a portion, that's your asset, that portion of the property that you own, and they do need to buy you out of that in order to give the proceeds to your estate. So that's something you just need to consider whether you would want that to happen or whether they're able to do it. But if you're thinking this is more of a gift, which I'm reading between the lines it is, then a joint ownership's the better way of going about it because it just automatically transfers to that sibling upon your death. And then in terms of helping the kids with, you mentioned with a gift, it could be a few different things. It could be to buy a house or start a business. So look, if it's to buy a house, we really like doing guarantor loans. Now that's only going to help kids so much. So we've spoken a little bit about guarantor loans. It's using the equity in your home, which you have plenty of, enabling them to front up a deposit for a property. So, I mean, that gets added to the loan. So they have to meet serviceability in order to access that guarantor loan, the deposit loan. You might not want to do that, and it might be better. You might want to help them out actually with a cash gift. We've seen a few examples with clients where, do a combination of the two. So the child might not have the serviceability to take on the debt of the 80% mortgage on the new property, as well as the deposit loan, which is guarantor arrangement. So it could be a combination of some cash, some guarantor loan. But look, if you really want to help them out, and you certainly have the means to do so, and it's certainly going to work within your plan, then I think cash gift is the way to go. The only thing to consider here is, I don't know whether you potentially a bit of estate planning and asset protection. Some people like to do a loan to their children. It protects in the event of marriage breakdown. That is actually a liability that needs to be paid back. So it's not a true gift, and it's quite a simple loan agreement that can be drafted up. So it can be, a a loan that has no interest rate attributed to it, but it is still a loan. So in the event of marriage breakdown, it's that proceeds won't go, in theory, half of it go to the marriage breakdown. I don't think you do joint tenancy with the kids. I think let them have the full main residence exemption on that property, allow it to be in their full name. I think there's a bit of sort of good education and behavioural stuff there, and having that full property on title in their name, the mortgage in their name, it's their responsibility, teaches them good sort of money management habits. So I think having it in their name is the better way. But yeah, I think the equation there is you need to think about whether you want to loan that money in case of sort of protecting it, and then how much of it they then use equity in a guarantor loan, and how much of it is a gift in cash. But I mean, you've certainly got the ability and the resources to gift it in cash, and there's nothing wrong with doing that. And Fred, the only other final thought, I mean, I'd be thinking about if you're a client of ours is I'd be just thinking about the tax planning around, I mean, even though you're going into retirement, the super pension's tax-free, obviously, but you've got substantial assets there in the family trust, which need to be distributed. So 3.4 mil in the family trust, and that'll continue to grow naturally. So, if, we've got to think about the income from that and maybe managing that. So you kind of, the first thing I usually think about is, can we get more in super? And no, you can't. You're over the transfer balance cap already. So you're maxed out on super. So that's pretty much gone. There is mechanisms. You could still do concessional contributions. So even if you're over the transfer balance cap of 2 mil, you can still do the 30,000 concessional contributions per annum. You'd only do that if the income in your personal name from the family trust income was really, I think the real bang for buck is if an individual's income is over 45,000. because you've got to consider the 15% contribution tax into super and whether you're netting any better off really in getting a deduction, a personal deductible super contribution. So I'd consider you could still do concessional contributions, but you just want to play it so that I think the threshold's about 45,000. That's where the income bracket changes. So if you're over that, maybe doing some concessional contributions, so a little bit more could go into super. It's not going to be able to go into pension phase. It'll be in accumulation phase, obviously, because you can only have up to 2 mil at the moment in pension phase, but it's still in a low tax environment in super with 15% tax rate in accumulation. So I'd be considering that. And then I'd also be considering, distributions of the family trust. So, I mean, you've got you and your partner. So, I mean, if we say there's 3% income off a 3.4 mil portfolio, well, that's about 100 grand of income. And that doesn't even factor in if there's capital gains, if you sell things, say, for example, you sell some of these assets to gift money to the kids, or if you're just, trading some of it and reallocating some of the funds within the family trust, there might be capital gains on top of that. But on a pure income basis, there's about 100 grand there. So that would be split, equally between you and your partner. But I'd read between the lines here and think that given your kids haven't, and they're in their early to mid 20s, they're probably living at home. So I think you'd want to have a look at potentially if there's benefit in distributing income to them. Whilst they are living at home, you can distribute income to them if it's for, reasons, if it's to cover certain expenses for them. So, but there's good ability to distribute income to them, but it depends if they've got, jobs. I don't know what their job situation and their income situation is, but it's sort of just about playing the tax brackets there on a family unit basis in order to minimize some of that tax. And, and if you think about it as well, the 3.4 mil, I'm thinking today, the level of income, but as that portfolio grows, the 100,000 income as a minimum, that's probably going to continue to grow and grow. So, over time, I think it's worth just thinking about that sort of tax planning element with regards to the family trust portfolio. The next question is from Paul. Paul's question got cut off a little bit, but I think we've got the full gist of it here. I'll read it out to you. So he mentions in your Q&A podcast on the 21st of July on trusts, it prompted a question to me about simple trusts. My parents have various bank and share accounts in trust for the grandchildren. What in practice happens to those accounts when they die? And I'm pretty sure that's where it got cut off, and I think that that's the end of the question. So a simple question there, just around what happens from an estate planning perspective to a trust, a family trust, is what I understand the question to be. So how the assuming your parents, so there could be two arrangements. They could be the trustees of the trust, or if they have a corporate trustee, they would likely be the directors of that corporate trustee of the trust. Be complicated there, but either way, it's still, they have control. I'm assuming either via a company, a corporate trustee, or directly as trustees, they have control over it. Now, what happens when they die? A trust is actually a little bit of a separate asset to an estate asset. Like it's dictated more by the trust deed. So really, who takes over the trust, that should be dictated in the trust deed. There should be a section in the trust deed which outlines the transfer of ownership upon death. So that actually supersedes the will. So that comes before it. The trust deed supersedes the will. So really, if there's not instructions in the trust deed outlining, okay, we're going to appoint this person as the appointer, this person as the trustee, these people as the beneficiaries, and therefore who's taking over ownership of the family trust, then it then defaults down to the will. And if the will, it's then allocated in line with the will. And if the will is, to you, and if you, I don't know if you've got siblings as well, it might be split accordingly between siblings. So you might all be appointed trustees of the trust, or it might just be you. I'm not sure. But yeah, it sort of starts with the trust deed and then it transfers accordingly. The trust is sort of, it's its own entity. So that trust deed dictates who it goes on to. And trusts, family trusts have a lifespan of 80 years, typically. Fun fact, actually trusts in South Australia, I've come to learn, can actually be perpetual. Trusts established in South Australia, quite interestingly. But the majority, I believe all other states, it's an 80-year time frame for those trusts at which they need to be wound up. So that's what happens. And I think to your question here, Paul, what happens with the accounts within the trust? Well, the accounts stay the same because the bank account and a share trading account, they're owned in the name of the trust. So they stay. Nothing really changes with those. It's really about at the trust level where the ownership changes upon estate planning perspective, what happens there. So nothing really happens with those internal accounts. And I think, my advice to you is have a look at the trust deed, if you can look at that. And that would be the starting point. And then if not, then it would be dictated by the will if there's nothing in the trust deed about transfer of ownership. Hope that answers your question, Paul. The next question here is from Dan. Dan says, I'm a big fan of your podcast and listen religiously. Thanks for putting out such valuable evidence-based practical content. No problems, Dan. So he says, here's a debate I've been having with myself. After buying 3 properties, every time I've compared my own research to what reputable mortgage brokers offered, I've come out ahead. My loans have been cheaper from cheaper ADI, authorised deposit taking institution lenders, while brokers tended to recommend big banks with higher fees and interest rates. For someone with a pretty straightforward financial situation, when does a mortgage broker actually win? Is there any scenario, or even a niche one, where they genuinely deliver better value than a DIY research, or is their real strength only in complex situations? I'm also curious, are there regulatory or commission-based reasons why brokers rarely recommend smaller, cheaper lenders? Feels like this could be a spicy topic for the podcast, and I'd like to hear your take. Well, yeah, that is a bit of a hot take there, Dan. I mean, you're kind of distilling the entire mortgage broking industry, the reputation or the value of the entire mortgage broking industry, I guess. Look, I think, yeah, to your point, where's the value? Of course, there is more value in complex situations. So, as you say, if it's a pretty straightforward scenario, there's the value add is not as good. Whereas someone has multiple loans, there's complex income and how that's treated by the banks. Yeah, as you go up further up in the complexity, it gets more value from a mortgage broker. But even on a simple situation, there's a case of, look, I think you've mentioned here going to not the main banks and going to other lenders. I mean, my experience, typically the big banks offer the better rates. And by going to second, third tier lenders, they are more flexible in terms of lending terms, but they generally charge for that and it's in a high interest rate. I mean, my experience is that's the other way around. The big banks, if you can get lending with big banks, they're typically some of the best deals in our experience. And so where does a mortgage broker actually win? Well, it's a case of what you don't know, I guess. I mean, you mentioned here you've done your own research and you've managed to come out ahead of what some of your mortgage brokers have offered. But look, a mortgage broker will compare across all lenders, multiple lenders, like a large array of them. And they have knowledge and experience and offerings that, the average punter doesn't have. So it's a case of what you don't know here. If you've done pretty well just doing your own research, then fair enough. But I mean, I kind of think, why wouldn't you use them? You don't pay, most mortgage brokers, you don't pay a fee for it, as they are paid on a commission basis from the bank, and then that's not really impacted to you in terms of your lending arrangement. So why not use them? And they're there for further, lending down the track, or rate reviews, or looking at different, refinancing options down the track. They're then there to work for you. So I'm not sure why you wouldn't use them, really. But I mean, there is a huge amount of knowledge. I would say that the lending space it's really complex. Stuart has written a whole book about it. The rules of the lending game. It's a complex area, and I'm constantly learning things about it. So, I think to think that you know it all compared to people that have, decades of experience in it is a bit of an assumption. But look, I think, that's what I'd say about it. And is there, commission-based reasons why brokers rarely recommend smaller, cheaper lenders? No, I mean, the commission rates are all fairly consistent across the lending. It's quite regulated. So that would be sort of a conflict of interest there, and that's sort of regulated out. But no, I think it's just going with the big banks. It's a more seamless process. It's a safer approach. I think maybe brokers, really, we want clients to lend money in the safest way possible. And typically the big banks are kind of the strictest of it when it comes to retail lending. You can get more flexible by going to these second and third tier lenders, but you're taking on more debt, and arguably when you couldn't meet serviceability by going to the big banks. So it's a higher risk. So maybe brokers don't like it because they don't think you should be borrowing that amount. Maybe, I don't know, I'm guessing. But yeah, look, that's what I'd say about it, Dan. I hope that answers your question. Okay, the next question is from Fred, another Fred. And I thought I'd answer this one because it's quite timely, actually. Fred sent through this question in August, and it kind of relates heavily to episode 376, which I recorded, which is called How to Avoid the 17% Super Death Tax. So it might be a case that Fred's question's been answered here, and I'll definitely refer you to that podcast and that blog, Fred. So that's kind of very relevant to what you're asking here. So Fred says, I have a few questions regarding the so-called 17% death tax, which has been topical in recent times. First, does the recontribution strategy work for someone like me with a balance of 2 mil in super, or is it useful only for those with smaller balances? There's a lot of questions here, so I'll address them as I answer them. So it's still useful and it still works. So the thing here you've got to consider, Fred, which I talk about in that episode on the 1st of October, is you have to work within the transfer balance cap. So you are right on the transfer balance cap at the moment of 2 mil. So you could do a recontribution strategy as you've outlined. You could put 360,000. So you could, if you have, assuming you're at preservation age and you can access your super and you can withdraw funds, making that assumption, you could withdraw funds and then recontribute, putting 360,000 back in. So that's 120,000 per annum, but you use the bring forward rule, which you're aware of, you've mentioned here, where you bring forward 2 future years. So that allows you to do 360,000 back into super, and it effectively recycles the taxable component that's in super from taxable to tax-free. So yeah, you're aware of this, but I outlined that in more detail in that podcast. So the issue here is you can't do non-concessionals which exceed the transfer balance cap. So you're right on the threshold here. So in theory, if you pulled 360 out, you've got 2 mil in there, you pulled 360 out, you could put 360 back in, but not a dollar more, if you get what I'm saying. So it's kind of, as your balance grows, you will be limited because you can't make non-concessionals that exceed the transfer balance cap. However, it is still useful for you. I mean, even recontributing a little bit of your super fund and changing the tax-free and taxable component a little bit, it all has benefit, but it has its most impact for people that can do it a lot. And the other factor here is to consider is, I don't know whether you've reached retirement and you're drawing upon the super. It might be that you might stay under the transfer balance cap if you're also withdrawing to fund your retirement. So you might be pulling out, 100, 150 grand as well to fund your retirement. So you might be keeping under that 2 mil transfer balance cap. But to your point, yes, it is a lot easier to convert that components of your super fund when you've got a smaller balance, of course, because, if you say, for example, you had 360,000 in super, well, you could convert it all in one go. So yes, it's just a matter of, it takes more years and more time the larger your balance is, and it's also limited by that transfer balance cap. But of course, there is a more effective way of doing a recontribution strategy, which again, I'll revert you to that podcast on the 1st of October, is by potentially looking at opening up a second super account. That makes it more effective, the recontribution strategy, after the first recontribution, so in multiple years afterwards. So have a listen to that and you'll understand why. So there is a more effective way by doing that, what we call a smarter recontribution strategy. So then Fred goes on to say, look, continuing with this line of thinking, I expect that a recontribution planning is not feasible for anyone with balances of more than 2.5 mil as a practical matter. However, I have not heard this point discussed, so perhaps I'm missing something. No, you're exactly right, Fred. Yeah, once you reach, if you had 2.5 mil, you can't make non-concessional contributions anymore because you're over that 2 mil cap. So, that you're exactly right there, and it's not as relevant to people in that position. And then final question, Fred says, I've heard you talk about the idea of withdrawing super before death to avoid the 17% death tax. As you've noted, this might be easier said than done for obvious reasons. I was wondering if it might be possible to use a contingent withdrawal request to deal with an unexpected death. In other words, the trustee is provided instructions in writing today that a withdrawal request is acted upon a day before a member's death. Could this approach have legs? Well, it's a pretty tough one, Fred. Yeah, as you've outlined there, I mean, in theory, of course, you can avoid the death benefit tax if someone they've reached preservation age and they can access super and they can withdraw it. You can withdraw funds from super tax-free as a lump sum withdrawal, as a pension payment, but assuming in this situation you do it as a lump sum withdrawal tax-free. So if, in theory, someone knew that they were going to pass away and had the sense of mind and the capacity, the legal capacity to make that instruction to their super fund to withdraw the funds because they knew that they were going to pass away soon, then yes, you could avoid the 17% death tax if there was some taxable component in their super fund. So you are right. And yeah, we've spoken about this before internally, but the practicalities of this are just so difficult because who knows when they're going to die pretty much. And even if you are very unwell and you're terminal and you've been given a certain period of time to live, it's just not what people do. They're often in that point in time very unwell and lacking capacity. I'm sure there's plenty of people that have done it, who have known that they're, on their last legs, so to speak, and have managed to do this. But really, it's very hard in practicality to do it very often. But to your question, could the trustee provided instructions? Not really. I've never really heard of that because they're kind of strange instructions. I mean, and I don't really think most trustees of super funds can act upon these instructions because, what would they be if, someone's looking like they're going to die, pull all the money out of the super? So can't really do that. And it would still need the authority of the member to sign that off. I mean, I guess I wonder whether a power of attorney, so someone that's been given financial power of attorney to make financial decisions on behalf of someone if they're incapacitated. That's an interesting question. I'm not sure. I think that they may have the ability to do that but then you're still going to need for that person to be legally deemed incapacitated and therefore the power of attorney enacted. So there's a lot of hoops to jump through, but I don't think you could just give the trustee instructions here. I think it'd be more the route would be their power of attorney enabling that to do it on behalf of that individual if it sort of mapped that out, if the instructions were in that sort of power of attorney. So might be the only way, but it's very hard to do, Fred. But I like your thinking. And I'm going to answer the question from Lynn here because it's a similar topic here about recontributions to super. So Lynn writes, thanks very much for your most informative podcast. I've learned so much from you. I want to use the recontribution strategy of 330,000 every 3 years. It's actually 360, Lynn, but that's okay. 360 every 3 years because it's 120,000 non-concessional cap times 3 over 10-year period. Do I need to open a new pension account every 3 years? If so, can I roll over the amounts so that after 10 years I just have 2 pension accounts? My original pension account that has taxable and non-taxable components, and my 3 recontribution accounts rolled into one that are mainly tax-free. I would appreciate your advice. So, Lynn, to answer your question, technically, yes, you are opening a new pension account every 3 years because the rules dictate you can't contribute to a pension account. It's called an account-based pension or a pension account. You can't contribute further funds to it. However, most super funds, there's a pretty easy mechanism where you can do something called a pension refresh. And so what this means is if you want to contribute, you kind of pretty easily can contribute to a pension account just by you momentarily roll it back into accumulation phase. You then can contribute money to an accumulation fund, which is just a normal super fund. And then once it's contributed, then you recommence pension on the amount, which then involves that new contribution. So that's called a pension refresh. So that's how you do it. And you don't need to open up a new pension account to do that. Most industry super funds and super accounts can facilitate this for you. So just look up a pension refresh application. So, Lynn, ultimately, you could have an arrangement at the end of this recontributions that you're doing of just having one pension account. Much simpler. You're not doubling up on fees. So you can get yourself, if you are able to, I don't know the balance of your super fund, but let's say you're able to completely recontribute your entire super fund. So it's all in the tax-free component. You can then end up having just one pension account at the end of the day. But again, I'll refer you to that podcast I just mentioned before about the smarter recontribution strategy, which was on the 1st of October, around it's much more effective to use a second super account. So therefore you're pulling out money from the super fund, which has a mix of, you've mentioned you've got some taxable and non-taxable. So you're pulling money out of that and then you're contributing into the second one. And then depending on how the balance of your super fund, say if it's 500,000 or less than $1 million, however much it is, you should be able to convert all of that and recontribute it and convert the taxable component. And then by the end of it, then you can just have that one pension account. By the nature of doing that pension refresh, you should be able to then just wind up at the end of it once you're done having just one pension account. Okay, I've probably got time for one more question here, and I'm going to pick this question from Brad because I think I know who you are, Brad. I think we have spoken before. So let me read Brad's question here. I wanted to get your thoughts on something I've noticed in the unit market. I work for a property developer that delivers large-scale residential towers, the sort of stock we generally avoid as investors. Lately, I've been seeing a lot of resales come onto the market. Many are apartments that were originally sold 4 or 5 years ago, now being listed at around 50 to 100,000 less than their original purchase prices. If we were to deliver those same units today, with the impact of high build costs, the gap would be even wider. For example, I'm seeing apartments that would sell new for 500,000 plus being listed in the resale market for closer to 350,000. So from our side as a developer, it's a challenge. We're trying to move new stock at a very different price point. But from an investor's perspective, I wonder if this could present a short-term opportunity. Specifically, does it make sense to consider this type of stock on the basis that current resale pricing is well below the replacement cost, with the expectation that the market will eventually realign? Well, yeah, it's an interesting question, Brad. Look, my thoughts are it's not an opportunity that I'd be jumping at, really. I think what this does is it highlights the difference between build cost, replacement cost, and market value. and they're different things. Just because something costs a certain amount to build and construct, the market then is a separate thing which determines how much that is worth. And that's really the difference here. Now, of course, as you say, I mean, there is the assumption that, if the expectation was that the market would eventually realign and bring it back up to replacement cost or that build cost, then there's an opportunity there. As you say, if something's really cost $500,000 to build, but you bought it at a potential buyer bought it for $350,000, then the uplift is there. I don't know. Yeah, it's not an opportunity that I don't think I'd personally be jumping at. I see lots of examples in the market. Like if we look at like even large commercial buildings, there are commercial buildings that are trading on the market value way less than their replacement cost at the moment. And I just don't always think that market value will always align with replacement cost. And I think you'd need to be, so not at all downgrading, these particular apartments or buying apartments in general as investments. Some can be good. And certainly I think that there's, if you look at the Brisbane apartment market, it's done fantastically well over the last couple of years. So there's great apartments to buy that are investment grade. But I think it more comes down to the fundamentals of the property and, the appeal of them and all the various things we talk about being investment grade assets. So I think that's more what I'd be concerned about. But I think if we're looking just simply here at, the difference between market value and the replacement cost, I don't think it's really an opportunity that we'd be jumping at, because I don't think it always aligns. Sometimes things get sold and things can be bought for far different for what they cost to build. Ultimately, I think and very simplistically, the price of an asset is determined by supply and demand. It's the old supply and demand equation. And I think that that's a better determiner of value and price. So I think it's really, what it actually took to build. It's kind of not irrelevant, but it's not sort of the key metric. I think it's really looking at the supply and demand of that property, which will then determine the future expected growth rate and the true market value of the property. So those are the things that I've been looking at. It might be that there'd be good opportunities in those builds that you do through your current work, but I think it's more looking at the broader market in terms of what's the uplift going to be in those values. But I think it's an interesting situation that you raise here, Brad, because this is quite a common one. And I think this is why we're hearing a lot from property developers that the numbers just don't stack up in terms of, certain build costs and developments at the moment for what they're going to sell for and what the market's determining value. It just doesn't align. And that's because build costs are still so inflated at the moment. And, they're inflated mostly because of labor. Sort of digressing a bit here, but during COVID, the materials really blew out, and it was the cost of building went up so much because of labor and materials. Well, materials have come back down quite a lot, but the labor costs are still there, which is just driving up these development costs. And they're sort of, it's not an uncommon situation. I'm hearing a lot from property developers that numbers just aren't stacking up. And I think that's why a lot of them are more focusing on like high-end luxury apartments, which isn't really doing much to solve the problem in terms of housing supply shortages and, the issues that we're facing there in terms of the housing crisis. So a bit of a digress there, but that is a common problem that we're seeing, in that a lot of these developments just don't stack up, and the sale prices aren't really matching and aligning with the build cost. So I hope that helps answer your question, Brad. But look, all the best to you, and hopefully catch up with you soon. That's all I've got time for today. Until next time, bye for now.
Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.